Hello, everyone. Today we are going to cover flexible budgets and standard cost. This is going to be a little bit of a challenging chapter, so be sure to pay close attention to what we're talking about here today. So there are a couple different approaches to budgeting. One of those is a fixed budget, and this is what happens a lot of times with companies. They make a fixed budget, and that is just we predict that this is how much we're going to have in sales, this is how much we're going to produce, and we're basing the whole budget on that one idea. But it is very wise to use a flexible budget because this is going to base it on several different amounts of sales or producing the goods or whatever it may be. And that's a good approach to take because chances are we're not going to meet those exact numbers that we planned in the fixed budget, and it's going to make it challenging to see how we actually did. So this will all make sense as we go through the examples, but these are the two types of budgets we're going to focus on in this chapter. So when it comes to budgeting, we want to make sure that we budget the amounts, and then whenever the month or whatever the accounting period is passes, we want to compare the actuals to the budgeted amounts and then look at the variance. If you don't compare the actuals to how much you budgeted for, then it's a complete waste of time to make the budget. So you have to go back and compare and see what the variances are. So we're going to start looking at the difference between fixed versus flexible. So for this fixed budget, they are going to assume they're going to sell 100 units. That will be $80,000. And they think their costs to go along with that will be $56,000. So they'll have a net income of $24,000. So that is their fixed budget that they've made for this. When it comes to the flexible budget, they said, we might sell 100 units, or we might sell 120, or we might sell 140. We don't know exactly how many we're going to sell. So we're going to base it off a variety of possibilities when it comes to our numbers. So then it shows in sales dollars that it could be 80,000 if we sell 100 units, or it would be it'd be 96,000 if we sold 120 units. It would be 112,000 if we sold the 140 units. And then the costs are, of course, going to go up according to that as well. So this looks at many different possibilities, not just that one. I'm assuming we're going to sell 100 units, and that's all that I'm going to do my calculations on. So the purpose of a flexible budget, we want to show those revenues and expenses at multiple levels of activity, and that will help us to compare it to the actual level of activity. And we're going to see this in multiple examples. So it shows what if we sold 100 or 120 or 140, what if we did that? And it really compares apples to apples, because if we actually sell 120 and we only did the fixed budget of 100, then we're not really comparing this properly, because that's not the number of units that we sold. So that will really help us to improve our evaluation of the budget as well, and help us to get a very clear picture of how well we did at sticking to the budget. So let's first look at this fixed budget. So they said they were going to sell, in this one, these different numbers. So they sold 12,000 units. That's their actuals, but they had made a budget as if they were only going to sell 10,000. So in sales dollars, they expected to bring in 100,000, and they actually brought in 125,000. So that gives them a favorable, that's where that F comes in, a favorable sales amount of 25,000. But of course, they made more money than they would have if they sold 10,000, because they sold 12,000. But it's not really comparing apples to apples, because I don't know, just looking at this, did they sell it for the same amount that they planned to? Was 125,000 what they should have had in sales, or did they have to discount stuff in order to sell 12,000? I don't know, just looking at this. So this is the fixed budget. The cost of goods sold, oh wow, we only thought we were going to spend 10,000 on direct materials and only 15,000 on direct labor. And here we spent 13 and 20,000. So we had unfavorable because we spent more. We had unfavorable amounts for our direct materials and direct labor. We must have done something wrong, right? Not necessarily, because remember, we only based this on 10,000 units. When in reality, we sold 12,000 units. So I have no idea if that's good or not because we're not comparing apples to apples. We're not comparing a budget of 12,000 to us selling 12,000. So I'm not really positive just looking at it like this, if that's good or bad. Same thing with factory supplies. We spent more than what we had budgeted for because we only budgeted for 10,000. Utilities, we spent more. Should we have spent more? I don't know. Not with this budget. Depreciation, that's good. It stayed the same because you're going to depreciate it if it's straight line, based on time and not based on how many units you produced. The supervisor's salary means the same amount every single month or year, so that would be the same, so that's good. Sales commission, that was 10,800. We only budgeted 9,000. Is that bad? Well, it's unfavorable, but only because it's based on the wrong amount. So when we get down to the bottom and we come to total expenses, wow, we spent 11,600 more. So it was unfavorable than what we had planned. Well, that stinks. But does it? Because if we look at income from operations, we actually had 25,400, which was 13,400 more than what we expected to make in income. Wow, that's more than double. So that seems pretty awesome. But I'm not sure if that's as much as it should be. Maybe it should be even more with 12,000 units. So you see how this just does not compare. We are not comparing the right amounts to each other. So this is the big struggle in a fixed budget. Excuse me. So when it comes to a flexible budget, we're going to flex the budget for different activity levels. So we have to know what the costs are, which is what we have been focusing on in this semester, and we have to see how that changes based on activity levels. So we want to know the total variable cost change that goes in direct proportion to the activity. Again, depreciation on a straight line, that has nothing to do with the activity. Whereas direct materials would have a direct correlation to how many we produced and sold. So we need to figure out what those numbers are. And then those fixed costs, like I said, with depreciation are unchanged. Try to pause for a second so that if you want to take notes, you can pause the video, but I'm going to go ahead and move along. All right, so here we have our fixed budget and our flexible budget. So our flexible budget, we're going to see how that was created, and then we're going to compare it based on how much we actually sold. So with our flexible budget, they figured out the variable cost per unit on the ones that, were related to variable costs, that we did have a direct correlation to the activity. So for sales, they said we want to sell them for $10 an item. So if it's $10 an item times 10,000 items, we'd make 100,000. If it's $10 an item times 12,000, we'd make 120,000, and so on. Direct materials, it should cost us $1 per item for direct materials. So $1 times 10,000 is 10,000. $1 times 12,000 is 12,000. And then again with 14,000. Then when it comes to direct labor, it's $1.50 per unit that we sell. So we take the $1.50 times each of these to get how much our direct labor should be. Factory supplies is only 20 cents per item. So we take the 20 cents times 10,000. We get 2,000, 20 cents times 12,000, we get 2,400. And the utilities has a direct correlation. And then that gives us our total variable costs. Then we break out our fixed costs separately. We know that depreciation and those supervisor salaries are going to be the same regardless of how much we spend or we sell or produce. So this gives us a flexible budget for 10,000, 12,000, and 14,000 units. And in fact, if you sold 11,000, you could easily come up with a flexible budget because you have done all of this work prior to it. So hopefully this is making sense. So we know that they actually sold 12,000 units. So we will use the numbers in this column that we based off of these calculations. $10 times 12,000 units, be 120,000 in sales, and so on. So this is a way to look at it with the formula. We have those total fixed costs that were at the bottom with the depreciation and the salaries, plus total variable costs times the units of activity. And that's what gave us our total budgeted cost. So this is the same thing we just saw on that chart. It's just seeing it in a different view, in a more formula view. So then that brings us to our budget once we have our numbers, which again was 12,000 units. So we get to easily pull the flexible budget with the 12,000 units. We're not basing it off that fixed 10,000 units that really didn't help us to compare it. So we actually sold 12,000 units and we made $125,000 off of that. How could this happen? How could we have 125,000 instead of 120? So we have $5,000 favorable variance. So we made more money off those 12,000 units than we even planned. This could be that there ended up being a higher demand and we were able to raise the price. It could be that some of our products were in Walmart where it was less expensive and that's where we thought we would sell the majority. But then some of our items were in a boutique and we sold more of those. So we actually got a higher dollar. Could be something like that. But we made 5,000 more on those 12,000 units than we thought. So that helps me to clearly see that where I couldn't see that with the fixed budget for 10,000 units. Direct materials. So we were expecting to spend $1 per unit, which would have been $12,000. We actually spent $13,000. So that was 1,000 unfavorable. So then as a manager, you would look in and say, why did I spend $1,000 more on direct materials than what we had planned? And you'd have to look into why that was. Same thing with direct labor. It was unfavorable for some reason. So you'd look into it. Was it that the employees were not efficient enough and we end up having to have them on the clock for longer? We need to take their cell phones away. Is it that it actually takes longer to make it? The employees did a great job. They stayed really focused, but you cannot make all these products in the amount of time that we had budgeted for. So we have to look at it that way. We have a favorable, we had planned to spend 2,400. We only spent 2,100. Favorable difference of 300 in factory supplies. So that's good. We must have been wise with that. And then you look at it going forward. Well, maybe we don't need as high of a budget for factory supplies as we thought. So we can bring that down. Or maybe that was just a, we just got a good discount or something. So going forward, we still do need to have that high of a budget. So we go through all of that and then we look at the total fixed cost, and depreciation stayed the same, supervisor salary stayed the same. You notice the total fixed cost is higher than the 20 or the 19,000 that we have here. That's because there are other fixed costs. I just couldn't fit them all in on this slide. But it looks like even though it was fixed, we still spent 200 more. So we had a $200 unfavorable variance in fixed cost. How could that happen if it's fixed? Well, the way that can happen is maybe it was rent and the rent went up a little bit, or insurance. We had a claim and then our insurance went up or something like that. So even fixed costs can increase or even decrease, even though we were expecting them to be the same. It's just not going to fluctuate nearly as much as variable costs, and we would expect them to stay the same, but things can happen. So when we take all this into consideration, was that 25,400 that we saw in income when we did our fixed budget, was that good? Yes, it was 3,000 more than we expected to have in income from operations, considering the 12,000 units. So we actually did really well on this, and that is great. So going forward, we know we might need to tweak our future budget, but we know that we did well this month. Okay, so the next part of the video, I'm actually going to make it a second video. We're going to talk about standard costs because they're really quite different. They both have to do with budgeting, but I'm going to break this into two videos. So you can watch this one and then go back and watch the second one on standard costs so that it will be more manageable pieces of information.